Welcome. So, you know how we're all swimming in ESG scores and sustainability reports, right? It's a lot. But how do you actually cut through all that noise and figure out what it means for the bottom line? Well, that's what we're tackling today, a real practical guide to connecting ESG analysis directly to a company's valuation. And this, right here, is the million-dollar question, isn't it? It's one thing to have a score, but how do you actually value it? We've got more data than ever before, but the real magic, the real art, is in translating that data into a hard number. This explainer is all about the how we move from abstract ideas to models that actually work. So here's how we're going to break it down. We're going to start with the basic approaches to integration. Then we'll get into the super important step of figuring out what actually matters, what's material. And finally, we'll bring it all home and connect it to valuation. All right, let's dive into part one, the approaches to ESG integration. Think of this as having two different but, totally complementary lenses for your analysis.
Okay, so on one side, you've got your qualitative analysis. This is the art of it all. It's about using your judgment. Are the company's net zero promises actually credible? What's the real safety culture like? Then on the other side, you've got the quantitative stuff. This is the science, the hard data. We're talking about crunching the numbers on carbon emissions, water use, employee turnover, all that good stuff.
But here's the thing. In the real world, the best analysis isn't just one or the other. The line gets really blurry. You're constantly blending the two. You use the numbers, the quantitative data, to sharpen your judgment. And you use your qualitative insights to ask way smarter questions of the data. They really feed off each other. Okay, so once we've got our analytical approaches down, we hit the next critical phase. We have to figure out where to focus. Because, let's be honest, not every single ESG issue is going to move the needle financially for every company. The real trick is separating that crucial signal from all the distracting noise. Standardized frameworks like SASB, they're fantastic starting points. They really are. They give you a map of what's probably going to be material for an industry. But you know what they say? The map is not the territory. The real work, the place where you can find an edge, is digging deeper to find those unique, company-specific risks the map might not show you. And this table just makes the point so perfectly. Look at this. You've got 3 pharma companies. The big industry issue is product safety. But for Company A, they've got their act together, so it's a low risk. Company B, oof, weak policies, a few fines, that's a high risk. And then there's Company C, which is still in R&D. For them, it's not even a commercial risk, yet. Same industry, same factor, but 3 totally different risk profiles. Now for a great real-world example, Jazz Pharmaceuticals. If you just look at the SASB framework, materials sourcing isn't a huge deal for the pharma industry. But a sharp analyst sees that Jazz makes a cannabis-derived product. And suddenly, boom, material sourcing is a massive deal. Because growing cannabis is way more complex and regulated than typical pharma manufacturing. It's a perfect case of human judgment finding a risk a simple screen would totally miss. All right, this is where the rubber meets the road. We've done our analysis, we've zeroed in on the material risks. Now for the payoff. How do we translate all that amazing insight into an actual number? How does it change what we think the company is worth? The process itself is pretty straightforward. You can really break it down into 3 logical steps. Step 1, you've identified that material ESG factor, like the sourcing risk for Jazz Pharma. Step 2, you forecast how that could actually hit the financials. Could it drive up costs, hurt revenue? And step 3, you take that forecast and use it to adjust your key inputs in your valuation model. So when we talk about adjusting inputs, what are we actually doing? Well, you've basically got 3 main levers you can pull. You can go right into the financial statements and tweak your forecasts for revenue or costs. You can change the valuation multiple, arguing the company deserves a premium or a discount compared to its peers. Or if you're building a DCF model, you can adjust the discount rate to reflect that ESG risk. Let's paint a picture here to make it tangible. Imagine a company that operates somewhere with a lot of water scarcity. Now, if that company has amazing best-in-class water management, it has way lower operational risk than its competitors. That's not just a nice thing to do, that is a durable competitive advantage. And that can absolutely justify paying a premium valuation. And here's what that looks like in numbers. If the rest of the industry is trading at a PE of, say, 15, our company with that awesome water management might deserve a multiple of 18. And you can see this isn't some fluffy, feel-good thing. It's a direct reflection of lower risk and what you expect to be higher quality, more sustainable earnings. But of course, it works both ways, right? This quote gets at a core investing principle. If you're going to take on more risk by investing in a company with some shaky ESG practices, you better get paid for it. And how do you get paid? By getting a cheaper entry price, a discounted valuation compared to its better behaved peers.
So this all leaves us with a really fascinating question to think about for the future. As ESG data gets better and more standardized, is the market just going to price all this stuff in automatically? Or is the sheer mountain of data going to make a sharp analyst judgment? That ability to find the next Jazz Pharma story even more critical to generating real outperformance. It's something to chew on. Thanks so much for joining me.